Okay, let's go. Amazing day. Amazing day. Let's get started. So look, let's have a look at our strategy. Let's have a look at the strategy and let's get straight in. Unfortunately, I missed my entry for this gold trade, but I want you guys to have a look at the strategy and understand how you could be catching trades and how you're going to be catching trades for the rest of the day. Let me just see if there's anything else that we can actually catch. We can actually catch straight away. Let's have a quick look over here. Let's have a quick look because I have my eye on something. Okay, maybe. All right. So there's maybe an entry on GU, and we just missed an entry on gold. I'm just having a look at this GU right now. Yeah, there's maybe an entry on GU happening right now, but maybe not. I'm going to explain to you why. Let me turn this down. Let me explain to you why, okay? So the concern is that this GU wants to push up and tap into an imbalance above. I'm going to wipe this chart, all right? So we start again. I don't want it to confuse anybody, all right? I want to start again, and I want to be looking at... let's look at GU first, because there might be an entry on GU right now, all right? So the entry on GU is only in regards to potentially there's an imbalance above from all of this action up in here, all right? So have a look. Previously, this market was, made a big breaker structure M, and essentially it hasn't tapped back into that level, all right? Yes, we can see that there was a battlefield here. What do we mean by battlefield? We mean an area where the market was finding it hard to break. It's finding it hard to break, then it broke through it, then it sat on it. You hear the term, resistance becoming support or support becoming resistance. And then we've seen the market here dancing around. What we ultimately want to see from here is this. Boom, boom, okay, on a bigger picture. So therefore, if that is the bigger picture, I'm going to move this out of the way. The smaller picture means that the entry could be right now based upon this. Have a look. Based upon the fact that the market came and first of all, did what? What's the first thing that we're interested in doing to take a trade when? Somebody tell me.
After the liquidity's been taken.
After the liquidity's been taken. Good morning, my brother. All right. So look, have a look. Here was Asian session. All right. Here underneath this session was previous New York session and a previous low. It's not just about the sessions. It's about wherever you see these V bottoms, and below these V bottoms, let me just extend one. There is liquidity underneath here. Let me make that a brighter color so we can see it. There is liquidity below this level. All right. Here, the market came and nam ate liquidity. Okay. And then we can see how the market made a breaker structure W, as in it made some structure in here, pushed down, pushed up here and broke structure. That potentially is an indication above this structure in here. Yeah, I'm on a 3-minute time frame, but that potentially is an indication here above this section here. Okay, and then the market is now coming back and tapping into the imbalance, which is ultimately where we saw, where what broke that structure. Okay, so right now, literally, I'll tell you what I'm going to do. For anybody who's there, I'm going to take a jab on this. All right, I'm going to take a jab on this, placing my stop below here, and I say a jab on it because there is a concern. I'm letting you know from straight away there is a concern. What we're going to do is we're going to wait to see if we get a confirmation in the candlestick patterns. If we see the market come out of this area and close outside of the imbalance. That's what I'm going to wait for. We're going to wait, all right? But I'm going to try and take a jab on it because I showed you the bigger picture on the 4-hour that this market might want to push back up into these levels up in here, all right, before decided to come down. However, I am also fully aware that the market has been making these lower lows, okay, and lower highs, and we're here at the moment. This market could decide to just rock and roll. Now, I want to do the bigger picture analysis, but let's just keep an eye on this quickly. And then I'm going to show you a gold entry that we just missed about 20 minutes ago, half hour ago. but based upon the exact same strategy, the exact same concept of liquidity being swept first and foremost. Now, what I'm waiting for here is a few things. We've got, look, a 1 minute close all the way deep into this imbalance, because there's still imbalances here on the 1 minute, coming all the way down to here. If we go to our 5 minute time frame, we can see that right now, there's a minute and a half left of this market to come and wick, and the wick to come and close outside of this area. Here was the imbalance. Yeah, here was the imbalance on a 5 minute time frame. There's imbalance there. Yes, there is. But on a smaller time frame, we drop down all the way down to our 1 minute time frame. We see imbalance coming all the way down into here. Okay. So what we'll do is, as we're all here looking at it together, instead of, getting involved without getting a confirmation, because it's not like a limit order that we've placed. It is going to be a manual execution. And when we have manual execution, we can wait to get those additional little confirmations. Now, not gonna lie to you. I would have preferred this as the entry, all right? I actually believe that this was the entry, and now the market's doing something else. Because, have a look, I wanna see a manipulation W. Now, what do I mean by that? And I'm gonna explain this to you. We're getting high level now. Here's the manipulation W. Here's a normal W, okay? Here is a manipulation W. Just understand what I'm saying. This is the source. Here is a normal M breaker structure, which we see in the markets, okay? For example, like this. Here is a, whoops. Here is a normal M. Let's go again. Here is a normal M, okay? And here is a manipulation M. Now I'm tapping into, so this is what's on the right hand side is ultimately what we like to see. Because from there, then the market does this, taps into where we can see an imbalance somewhere in here, and then goes. And let me show you it. It's not here. So good job we waited for confirmation. It's not here. It was here. Because look, here is where the liquidity was, over here, right? The market came and took that liquidity, boom. What do we see here? Does this look like a normal M, or does this look like a manipulation M? Or sorry, W, sorry, yeah? Does this look like a normal W, or does this look like a manipulation W? Tell me, I'm asking. Does this look like a normal W in here, breaking structure on the 1 minute time frame, or a manipulation W? If you're finding it hard, just have a look over here. On the left hand side we have normal. If I put a line in here, on the left hand side we have normal M's and normal W's are ultimately breaks of structure. They're ultimately indications.
Okay. I've looked at the two.
Go on, Jay. You've muted yourself again. Go on. Go on, Jay.
The one on the left, the second part of the W is high up, so it don't come down as far before it goes up. And the one on the right goes down, and it looks like it captures liquidity before exploding in the other direction.
So which one is it? Is it this one or this one? Is it this one here? Or this one here?
That's the normal M. And the one on the right is the
sorry, double. This is W.
Sorry, W.
Yeah, I keep getting confused as well. So this is the normal M on the left. So let me just write it in there so no one gets confused. Yeah, this is this. I'm giving you guys the extra source. This is another level now. All right, but for you to increase your. So this is say normal. All right, and let's just say on this side we have manipulation. Now ultimately, the best trades and what you're looking for is these manipulation W's and M's, and just to put it into perspective, they are breaks, or they are indications. So indication corrections and continuations. We ultimately want to see these indications. Have a look at it. Pushes down. We don't get excited. We wait for some structure. Pushes back up. Pushes further down, and then that means that that this in here becomes structure, right? That's the last high before the lowest point, alright? So therefore, when it pushes back up past here, this is our manipulation W. Have a look at the imbalance from essentially where the energy started to break the structure. Have a look at the imbalance. Pow, pow. Have a look at your entry. Where do we take that trade to? Well, to the next, to the high, to that session high that market went to. But let me tell you something for free. That trade was only in a matter of minutes. Have a look here. It's only in a matter of minutes, even if you just took the imbalance up until here, 1 to 8 trade. Even if you put your stop below this swing low, a quick 1 to 3.5 trade in minutes. We're talking about 15 minutes. All right. Let me show you why. If you can see this, if you want me to explain this one more time, someone tell me explain it one more time. If somebody wants me to explain it one more time, tell me to explain it one more time. We'll go over it right now.
Yes, please. Just one more time.
Fantastic. All right. So what we look for in a trade before we take a trade is we want first and foremost liquidity to be taken. This was trading in the Asian session here. Look, when London came, listen, we're not looking at the London move first. With London, it started pushing down here when London opened 7 o'clock this morning. Can you see this blue line here? This blue line, if I zoom out, is a previous New York low, meaning there is liquidity, meaning I drew this little blue line below this level. There is liquidity, a pool of stop losses that stop this market from coming down here. Boom, we want to buy from here. There's a pool of liquidity here. The market first and foremost captures liquidity. That is tick number 1. We need to see the market capturing liquidity. Yeah, I dropped down all the way because on a larger time frame, this is just a spike. But when I drop down to my 1 minute time frame, and I'm allowing you guys, because we're getting more advanced, to be able to look at this on a 1 minute time frame. It happens on all time frames. But I'm allowing you to look at it here because it's going to allow you to get in and out of the markets within this window of our key windows, London window, New York windows, etc. We look, this is a lovely push down, grabbing liquidity. Nam, 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 nam. Now, what we want to see is we want to see a manipulation W if we're going for the buy. If we're going for the sell, we want to see a manipulation M. What is the difference? One is a normal McDonald's M. Yeah, come and get your McDonald's from this M. Come and get your this is the W, your normal W. Maybe even sometimes this one's even higher. All right. And another one is a manipulation W, where that right shoulder is higher than the first shoulder. Or in the W sense, for a buy, this leg here is lower than the previous leg. And ultimately, this is an indication because it broke this structure. This is an indication because it broke the structure. This is also an indication, yes, it breaking here, but not the one that's got most compelling for high probability trades. Have a look at this now. The market came down here, captured liquidity. I told you this blue line here was liquidity line. Now someone's saying, yeah, but Jay, it captured liquidity over here. Yes, it did, but it didn't break any structure when it pushed out. You see? It didn't break any structure when it pushed out this leg. It just kind of trickled up here and said, no, we ain't done. Pushed down here. From time it comes back up here, this becomes a structure because this is the highest point before the lowest point. Do you get me? If it didn't push down here, well, the structure would have been up here, right? Because that's the mountain top. But there's another little mountain top in here, and that creates that manipulation W. Look, if I was to take it, slam it right on top of here, you can see how that shoulder or that leg is lower than the other leg. Yeah. Now, once it does that and then breaks structure, yeah, once this leg out breaks structure, you are waiting for the market to return to where we've seen the displacement. Yeah, this is really important that you get this. This is going to absolutely transform your trading. All right. If I'm going to mute the Amapiano because this is very important that you guys grasp this concept. This is going to transform your trading. If you understand and grasp indication, correction, continuation, what we're adding on now in regards to liquidity and a manipulation M or manipulation W is going to transform your trading, because it's going to discount a lot of trades for you, and it's going to give you high probability trades. This quick trade here, even if we was just taking into consideration the imbalance, was a quick 1 to 8 in 15 minutes. Your trading for the day is done. You've taken $100 and turned it into $800. You can go and sail off into the sunset. But let's know and understand what we are looking for, because a man or a woman that doesn't believe in something believes in absolutely everything. All right? They believe in everything. They're an atheist, they're this, they're that, they're this, they believe in God, blah, blah, blah. They believe in anything. Anything that somebody says that sounds good. They believe in money, the devil, they believe in whatever it is. So we have to have something that we believe in our trading, something that we're going to stick to. And this is what we're sticking to. We're understanding the concept of premium and discount. We're understanding indication, correction, continuation, but now we are adding the final layer of source. Yeah, I'm not going to say the final layer, but we're adding a layer of source that's going to transform your trading. You are only taking trades after liquidity has been taken first and foremost. Have a look at the liquidity. Asian session was here. Asian session was here. The market pushed down. If I zoom out, you can see here is a New York, the PM session low, identified by our indicator, but also identified simply by a V bottom. Look, simply by, if you was drawing a line, you draw the lines like this without there being any indicator. That would be structure. All right. Now, when the market came and takes the liquidity, how do we know that the market's finished taking the liquidity? But then we want to see it making a leg out. We want to see it pushing out and breaking structure. Look, the market came down here. Yeah, we had a little bit of a break of it here, but it wasn't in this leg out. Didn't really break any structure. It just kind of pushed up. We pushed down here. At this point, we still don't know, but we're very interested in seeing this here pushes up, comes back down here. Now, you've heard me say a million times when we was drawing our lines that if we was drawing a line, we must touch the last low. So let's imagine we had some lines in here. We might have had a line, for argument's sake, doing this, but then we would have had a line doing this. Let me make them both white. Why would we have had a line doing that also? Somebody tell me, because this is all ties into the way I've taught you this. Why would we also have this line in this angle doing that? Why? Why this angle here? Yes, we've got this, we're touching these data points here. Why would we have this angle happening like this?
To touch the last high before the lowest low.
Exactly. Because that last high before the lowest low is structure. So when this market comes down here and grabs liquidity, pushes up in here, creates structure, then pushes down lower, and then the most important thing, it makes a leg out that breaks the structure. That here is a manipulation W. This is what we're looking for high probability trades. This is a normal M or normal W. W is for buyers, M is for sells. Because obviously, at the point when it breaks this structure, it's an indication, yes, it is a break of structure. And yes, you still will get the market coming back in, tapping in and closing structure and running. But this, and same here with this W, but this manipulation M, where the shoulder is higher, and then it breaks structure for sells, or when the shoulder is lower, and then it breaks structure, is a very high probability setup. Because when it legs out, have a look at the leg out, that broke structure, you say fantastic, because liquidity's been taken from here. Nam. B, it's within our session time, our kill zone window of London session, first couple hours. C, we've seen a break of structure that on top of that was a manipulation W. D, when that push out happens, we've seen an imbalance, or some people, you hear them call it a displacement. Can you see this imbalance here? Now, if you solely strapped your entry, and you could do that as a limit order, you could go to work and say, I've seen it, I'm placing my limit order. An aggressive entry is just strapping it with your spread times 2, just around that imbalance. Have a look at the market. You don't get any more perfect than that. Right in that zone, making a reversal candlestick doji and push it up for a 1 to 8. And let me explain something to you. Also, what you're going to do with this trade, have a look. This is a 1 to 8 trade, yes. And you would have known where you're going to be taking profits, because you'll be looking at the London session, and that market went all the way to the top of the London session over here. Yeah, to structure up in here. Look at this. Where did it go? right in this imbalance over here at the top of structure by a bearish engulfing candlestick. This is a milestone. This is a point of interest. This is a point of interest because similarly, this market was up here. Have a look at the same concept. The market made a manipulation M over here. You might not be able to see it because your eyes are not attuned to it, but here it is. Look, manipulation M over here. So the market did the exact same thing and left this imbalance open. It left it open. Yeah, it made a little correction and continuation. Yes, and you could have taken that trade. But this is still a point of interest. Like, wow, we left this open. Is nobody going to close this window? It's cold in here. So when this market pushed out from here, after capturing liquidity, it pushed all the way back up at this level. So therefore, in this trade, and this is the final bit of source, because now I've showed you the entry, and you guys are going, oh, I get it. I can see the liquidity. Yes, Jay. I can see the structure there, the breaker, the manipulation W. Yes, Jay. I can see the imbalance, Jay. Oh, yeah, I get it. Oh, yeah, we are in this trade. I would have been able to set my limit order here or manually execute when the market came in here, especially when you saw the market make this candle. If you was watching it manually and you saw that candle create right there in there, hit the button. Yeah, that's a manual execution. You could have seen that candle create right there and just gone, you know what, boom, I'm in. Hit the button even for smaller entry. But let's just say you hit it for the whole imbalance, no problem. For a smaller entry, you would have seen that candle close right here, because candles close on the bullish candles close on the top right. You would have seen it close right there. You could hit your button there. That would have been a 1 to 11 trade. Now, let me show you something. What you would do in this is what you must do. When this trade gets to a 1 to 3, you are going to take off, you're going to take off 50%. You're going to go into your MT5, and if you've put 10 lots on, for argument's sake, you're going to modify the position, and it will say when you modify, if you double click into your MT5, you'll be able to go and change it from 10. It will show you the position that you've got running, 10 lots running with your stop loss. You're going to go to the 10 and change it to 5, and it's going to click sell. It's going to say sell 5 lots at whatever price. When you get to a 1 to 3, you're going to do that. Sell it off and take 50% off the table. Which if you're trading 1%, which I'm going to show you a strategy of how you get to trading a whole 1% of your prop firm account, then you're going to take that 1.5%, which is essentially what you should have banked if you're trading a 1%, off the table. You're then going to move your stop loss like this to entry, so you've got no risk, and you're going to let the rest of it run, which will bank you a further 3.5%. Because if you've taken a 1 to 3, then and it goes for a 1 to 10 for argument's sake, then you've got another 7 left, right? 7 times half, 0.5. If you're trading 1%, you've just taken half of it off. You've got another 0.5 running. 7 times 5 is 35. That's another 3.5%. 3.5% plus 1.5% is a 5% trade. Now you're thinking to yourself, okay, I get it. We're going to come back to this. Have a look at gold. Gold is here, sitting here. We have the Asian session. Gold comes, during the Asian session, it starts pushing in down and it's capturing liquidity from here. It captures some liquidity from here. But the reason why we didn't care about it here, because we're not in our key kill zone time. Am I making sense? Can you see why we got these rules? It captures some liquidity from below here, cool. It captured even some New York liquidity in here. And there was a little sell in here, but we're not going to bother with that. The market pushed down past this liquidity in here and tapped into an imbalance also. Now, the same way when the market captures liquidity, there's liquidity below this level here. Just imagine we're looking at the markets. We're waking up in the morning, look, it's 6:30, we're looking at the markets. We can see there's liquidity below this little V bottom here, but we can also see this imbalance. We can also see this imbalance in here. So we're watching this market come and tap into that after grabbing all of this liquidity. He grabbed liquidity from here, nam, nam, nam. From here, nam, nam, nam. From here, maybe he wants to make a big journey. Maybe that's why he needs so much food, so much fuel. But when we're watching it, have a look once again. We have seen this market. Let me go to even a 5-minute time frame. We've seen this market push in here, boom. We've seen the area where the markets come to grab and tap into this imbalance, and we've seen this leg out, that this wick breaks structure. The leg out, the wick breaks structure. It's a wick on a 5-minute time frame. On a smaller time frame, it's candles. Okay? Soon as it does that and it breaks over here, and that market pushes all the way up over there and breaks that structure in here after taking liquidity and closing the imbalance, I'm interested, have a look, in when it made that leg out, what imbalances exist in here. Now, yes, I can see one on a 5-minute time frame in here, but there's nothing to stop me from being inquisitive. Let's look at it on a 3-minute time frame, okay? Let's look at it on a 2-minute time frame, okay? Let's look at it on a 1-minute time frame. Let's make sure we got everything. Okay, I can see some more little imbalance in here. Ultimately, this area becomes a point of interest. Liquidity's been taken. A breaker structure W has been created. A manipulation W here has been created. Boom, 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 boom. Remember, these markets are going to look how they look. You're searching for your confirmations. They're not all going to look like they just came out of the box, but trust me, boom, 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 boom. It's a manipulation W, meaning I'm expecting to see this market come and tap back in, especially if I already think that for the bigger picture is it could be bullish, and then do this. This is what I'm expected to see, or at least get back up to this equal high. All right. So when I drop my time frame down, have a look, and I go and I'm looking at this, I'm looking at it and I'm thinking to myself, okay, I can place my entry here with my stop below these swing lows. Okay. If I want to be very aggressive, I can try and be extremely aggressive. I place my stop below this. Look, what is this? Bullish candlestick pattern. All right. So we're getting a bullish candlestick pattern in the right location within our time frame after liquidity has been taken on a manipulation W that the leg out is pushed all the way up here. Tick, 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 tick. At least I'm going to be targeting these London highs once again. All right. For my 1 to 3, which in our instance would have banked us 1.5% and been completely risk-free. Let's have a look and see what happens. Right in that zone, right into our candlestick zone over here. Let's see what happens. It's the exact same trade as this. They're completely two different pairs. Yeah, it's the exact same trade. So I'm telling you that this is what you are looking for. You're looking for liquidity to be taken. And the reason why we're restricting things within these areas is to give you high probability, high chances of your trades to be successful. What do I mean by that? I mean that you want your trade to be trading. Just like you want your dance to be dancing and you want your car to be carring, drive to be driving. You want that fuel, that the thing that you came for happens. You do not want to get to the dance when there is only 3 people there and the music is echoing. You don't want to be there then. You want to get to the dance when it is ram, it is popping, everybody's moving together, the music is thumping, and there's a vibe. When there is a vibe in other markets is when there is volume. When London wakes up and all the traders start sitting down there, we see a spike of, I've showed you how to identify volume. We see a spike in volume, in activity. Do you get what I'm saying? There's not only one guy in the club. You see, if there's only 3 guys in the club and he decides to fight, to start getting into a fight, you're going to walk into the club and it's no longer going to look like a club. It's going to look like a fight club because there's only 3 people in the dance and they're fighting. This doesn't look like a club to me. This looks like I've just walked into a boxing ring. If you're in a club that is ram and one person decides to fight, that is a little tiny fight isolated in the club between 3 people and there's another 997 people in the club. Who gives a damn? The rest of the club are still dancing. What do I mean by that? I mean, when there is little volume, there's a very higher possibility that whales or news or other factors can mess up what your trades are supposed to do, your technical analysis. When you're trading crypto coins, you don't want to see that there is no volume in the markets, because that means that one person can move the markets. And I'm talking about crypto coin, altcoins, all the shit coins that you've heard me discussing and talking about. One person can come in and say, I'm going to buy 100 grand's worth of King Louis coin. He single-handedly is going to spike that market because there isn't enough. All of a sudden, it's like you're walking into the tiniest little corner shop and saying, I'd like to buy 1,000 bottles of Hennessy. He's going to be like, 1,000? Okay, 1 second. He's going to run in the back, see what he's got in the back. He's going to be calling his cousins, brethren. They're going to be coming around from everywhere. He's going to be going absolutely crazy. Going, oh my gosh, people want to buy Hennessy. It's crazy. He's going to be like, you have single-handedly made his sales for that day go through the roof. Single-handedly moved his market. If you go to the cash and carry, if you go to Costco and say you want to go and buy 100,000 bottles of Hennessy, they're like, yeah, we've had a good day today selling Hennessy, but it's not necessarily, been the highest earning day for Costco. They're not like going to be celebrating on that day. This is what I'm talking about in regards to this. When you're taking trades within these, I use this indicator because you know me. I don't use indicators. I'm using this indicator only for the sessions to understand where those kill zones are. You can see this one says London. If I wanted to, I could remove this text. Yeah. There's the only reason why I'm using it, for to understand these kill zones, because I have seen more and more by looking at my data when the most profitable trades have been occurring. Yeah? Within these sessions, I've shown you here. I'm going to show you guys again the strategy. So that's going to be for the third time for the people that just jumped on the call right now, and for the people that are just getting it, but they still don't fully understand it. All right? And we're going to draw it out once again as a step-by-step plan. You see, I'm trying to hold my own plan, my own strategy that isn't just works for me, that is something that you can follow, something that has some rules and some restrictions that I agree with. Yeah. And I'm saying to you, guys, I know a lot of different strategies. As in, when I say I know, I have an education of them, an understanding of them. I could turn around and say to you something stupid like, you can remember there was a breakout. So maybe there's people on this call that can remember a breakout strategy in regards to, when there's news events and buy stops and sell stops. This is nonsense. This isn't something that you can do and not something that's sustainable. There are other strategies that you could just trade the breakouts. I don't trade the breakouts. I think it's a little bit gambly because we understand that the markets, when they come back and they tap into a zone, unless you're on the small time frames. On the small time frames, it's different because what I'm saying is on the small time frames, there is an indication, correction, continuation in here. You just can't see it. So therefore, being able to place it as execute as when this market comes and taps into imbalance, or to get a confirmation when you see a candle, a certain type of candlestick, is the same as an indication, correction, continuation. And if you're taking this trade not on a minute time frame because it's too fast for you, and you're using a larger time frame, you will definitely just be able to wait for the indication, correction, continuation and take this to trade when it breaks the structure. That strategy works, bro. Don't think this is a new strategy. This isn't a new strategy. This is adding the source on your strategy to allow you to A, start becoming a lot more profitable. B, not having to be on your trades for the whole day, and to just add some extra restraints, confines. Because I heard somebody say something and it resonated with me. And it's like, I've said it to you many times, but you don't want to be in the ring forever. The longer you stay in the ring, the more punches you're going to take. Yeah? So like I said to you right here, this would have been a 5% trade. You only got to get 10% to pass your trade. In fact, in some prop firms, only 8% to pass your prop firm account. Now, what I was saying about the prop firm account and to being able to trade actually 1% off the account, I wouldn't do that initially. And this is something I didn't want to touch on today. I'll touch on it today. Go on, Brenda. Good morning. Or have you accidentally unmuted yourself? Brenda's accidentally unmuted yourself. Don't worry, I'm going to mute you back before I hear you breathing heavy. So either way, I'm saying when it comes to the prop firms, guys, I believe that you should first and foremost trade 1% of what you're able to lose, which is 10K if you've got a 100K account. But when you're up positive, so you're up 101,000 or 102,000, I think you can trade 1% of the whole account until you're back down again. Hear what I'm saying? When you first start on your prop firm account, I believe you should trade 1% of what you're able to lose, which in a 100K account is 10K, meaning that you can only trade 1% of 10K as your risk, which is £100. If you're wicked and bad, maybe you're fleeting around £100, £200. Let's just say £100 to keep it restrictive. When you start taking the one or two good trades and you get to 101,000, you can now say, you know what? I've got a cushion. When I see this setup, perfect, manipulation W, grab liquidity within my time frame, I'm going to trade 1% of the whole account, meaning willing to risk $1,000 on the trade. Why? Because in this instance, you would have made an additional 5% on your account, meaning that in two trades, or not in two trades, meaning that you're now at 6% for your account, taking a handful of trades. But if you're just starting, you can't do that because you're not up. And if you're down, you can't do that because now you're limiting your whole prop firm account to 10 trades, which when you get more advanced and more comfortable, you can do, because you're still saying, okay, I've got 10 chances to make 5%, which is good. You've got 10 chances to make 5%. If you make that 5%, then, if you've taken 5 trades badly in a row, if you make that 5%, you're back to break even. Cool. I don't believe that as a newbie, you should do that. You don't want to put your money into a prop firm and then 10 trades later, you have to go in and get more money. I have been there. I have done that. I am not talking to you from a perspective of just words. I'm talking to you from experience. Hence the reason why I'm going to be the best trader ever. Because I'm out here putting it in and putting in the energy and learning from my own experience and my own education. I know when I'm talking to you and I'm telling you about these different strategies, the Wyckoffs and this and that, it's not because I did some homework yesterday to have a great session this morning. It's because I know these, I've done this education. They didn't resonate with me. And ultimately, I've put together my own hybrid strategy, profitable, and understanding to see how these markets do certain things. Am I a multi-millionaire from trading yet? No, but I will be. Facts. And you're here with me understanding exactly how I do it. So why wouldn't you be as well if you want it? No reason why. Why not? So I'm saying to you, very, very simply, here we go. I'm going to write it over here and you guys can take a screenshot over here. I'm going to write it as anchor text. Going to double click in here. I'll go to settings on my anchor text. I want it to be text wrapped. Boom. Let's even flip it around. Let's make the background white. Let's make the text black. Okay, so let me get to my keyboard. All right, now, let's move the mobile phone, move the car keys. All right, so 1. Oops, okay. 1. Only, best way to stress. 1, am I near or in my high probability kill zone? I'll tell you what I'm going to do. I'm not doing it in here. There's no point doing it in here. Let's use Word. All right, let's use Word. I think I'm going to have 1 million documents open up. You're going to have to bear with me. If I do have 1 million documents open up, mind your business. All right. Let's wait till they open up. Yeah, so we'll do it in Word. So what we're going to go through, I'm going to repeat it now, but we're going to write it down. Am I in or am I near a high probability time zone, kill zone? What is a high probability? Can you tell me what kill zones am I talking about? What kill zones am I talking about for us, particularly in the UK? What kill zones am I talking about? Does anybody know? What sessions? Yeah, there you go. It was a bit broke up a little, cracked up for me a little bit, but that was King Louis saying London and New York. And the first couple hours of London, the first couple hours of New York, and there is another zone, which Louis alluded to a few times, is that kind of near the end, it's like an evening New York session. There is another little kill zone time, all right, where I'm sure said to me he's seen markets get very active then as well also, okay? Now, the Asian session typically frames what we're going to do. It creates liquidity on different sides. If we see liquidity taken from the bottom, depending on which direction of the market, because we still need to understand the overall direction of the market. If we see if the market's bullish, for example, then we see liquidity taken below an Asian session, then we're expecting to maybe that market to go and start running up in the opposite direction in line with the trend. Still have to be trading with the trend. Well, we don't have to be, but it's best. Okay. Now let me just write it all down. Let's go and find a blank. Okay. All right. So bullet points. Am I near? And let's make it, something that we can see. Am I near or in my high probability kill zones? i.e., first couple hours of London session, New York session. Should I put that New York evening session? So we'll just leave it like that for now. All right. 2. Okay. Oh, I've got 2 1s in there for some reason. I'm gonna unbold it. This is hard to read. I don't like this font as well. Let's try and get a font that we can read better. It doesn't matter. Doesn't matter. Okay. So, am I near my high probability kill zones? 2. Can I see an area or has an area of liquidity being taken? An area of, or has an area of liquidity been taken? All right. I will only take trades if liquidity is first swept, taken, tapped into. It's all the same. You see that wick happen like that? You see that reach up into liquidity? It's all the same. You hear someone else is going to talk about it being swept, liquidity being swept. Someone will say liquidity being taken. It's all the same, different language. Yeah? I will only get ready for a potential trade when structure is broken. Structure meaning last high before lowest low, or last low before highest high is broken. All right. Ideally, I want to see a manipulation, M or W, indication See the M's or W's are just an indication. You can even see it here in the text. Look at the M. Like I was seeing a meme and it was saying everything. Now I'm a trader. Everything looks like market structure and price action. Yeah. And the guy was in Italy or something like that. And he was looking at like a building. And he's like, oh, look, indicate. However way he was saying what his strategy. He was going, oh, look, indication, break of structure. He's looking at the roof line. But look at the M. Look at the actual M. The M is showing an indication by breaking some structure. But I just want to see a manipulation M or W. Something's ringing. I want to see a manipulation M or W. Ideally. Sometimes you won't get it, but ideally. All right. Let's see what's ringing. What's alerting. GBP USD is alerting. So a quick glimpse of why it's ringing. We're breaking down below the structure. You know, I actually want to be, like I said to you in there's two scenarios I was concerned about up here, but we want to see whether this market's going to break this sideways action and it still wants to continue going down in this bearish energy, or this market wants to come on here and tap into some 4-hour imbalances and some areas over here of possible liquidity, this market spiking up. So we'll leave that for now, but I know what's ringing now. All right, let's go back to our little plan. All right. Ideally, I want to see a manipulation M or W, i.e. indication. I then must see the leg out break structure. Yeah? The middle of our M or W. The middle point of our M or W. I must see it. This should cause some displacement. Or better still, this should be done with strength and speed, causing displacement. I'm going to put all the other words: imbalance, fair value gap. Yeah? We will wait patiently for price to return to that imbalance, and depending on what time frame, we will wait for the following: candlestick pattern, indication correction continuation on a smaller time frame, or limit order covering imbalance and last low or high, depending on last low or high. So what do I mean by that? I mean that ultimately the market will return back to our imbalance. Now, depending on what time frame we're looking at, you might not be able to see an indication correction continuation if you're looking at you're already on the 5-minute time frame or the 1-minute time frame. You're not going to see it. You're not going to see the market indication correction continuation. So you've got to, at some point, you've got to hit the button. So if it comes back, you see the market come back down and sit right into your imbalance, and especially if you're doing market execution and you see a bullish candlestick zone, a bullish candlestick appear, for example, a bullish candlestick pattern appear for a buy, or a bearish candlestick pattern appear for a sell, or you see a doji, a little doji at the bottom, which is an indecision candle indicating a change of direction, or you see a long wick to the bottom with a small body at the top, inverted hammer, another reversal candlestick pattern, you are going to execute your trade, placing your stop either below the swing low, below the, if there is a bullish candlestick zone below that wick, yeah. If you're very aggressive, you're just going to take into consideration the imbalance with your spread times 2. Yeah. We wait patiently for price to return to the imbalance, and depending on what time frame, we will wait for either or candlestick pattern confirming change of direction. All right. ICC, which ultimately we're talking about indication, correction, continuation on a smaller time frame, or a limit order covering the imbalance and last low or high. I'm just talking about the you know, where you're going to place your stop, or limit order. I'll make it as a separate one. We will place our stop loss in either aggressive, because just the imbalance, you know, medium is below last low, low risk below swing low. Any questions about what I've written there? Any questions about what I've written? I know it's not, you know, most coherent, but we're doing it live. Any questions about what I've just written? Do we want to go back over them? And I can elaborate on. If any, do you want me to elaborate on any of these areas? Because we're going to go back and look at it one last time. We're making good time. We're going to go back and look at the actual strategy plan, which played out this morning. And I actually had it marked out, but between me getting from the gym, getting home, that kills on. I missed that initial entry. All right, but we're going to look back and we can do some back testing, and you can also do some back testing also. So let's go and let's read these out again. I will only get ready or prepared. I'll only prepare. See, I told you we can rewrite this better. Maybe I'll ask ChatGPT to write it in fantastic language afterwards. I will only prepare for a potential trade when structure, last high before last low, last high before lowest low, or last low before highest high is broken. Structure is broken. Ideally, I want to see a manipulation M or W. I then must see the leg out, break structure of the middle point. Yeah, I must see the leg out, break the middle point. Okay, yeah. This should be done with strength and speed, causing displacement. I'm going to use the word imbalance more than displacement. It's mostly the word that I use. Imbalance, I'm going to put that one in bold. And we'll have this one just as some of the other words that are used. So if you hear anybody else talking about displacement, you know what they're talking about. It's not Russian to you. Yeah, you understand. Okay, he's just talking about imbalance. All right, cool, I get it. All right. We will wait patiently. We will wait patiently for price to return to the imbalance. And depending on what time frame, we will wait for either a candlestick pattern, ICC, or limit order. We will place our stop loss in either aggressive, which is just covering the imbalance, just covering, sorry, I've got this wire in my way, just covering imbalance. Is it imbalance? I don't even know which one it is, IM or IN, who knows. Medium below the last low, hopefully bullish or bearish engulfing candle stick wick. or also below the signal. Okay, now we ain't finished. We will target liquidity and or structural higher time frame highs. Oops. Higher time frame highs. We're not finished yet. We will what's the word? We will take partials.
50%.
There you go. You see, we will take partials of 50% of our position when we get to a 1, 2, 3. We will take partials. In fact, we're going to do it like this. We will take partials. I don't know why I've got this big old situation going on here. God knows. We will take partials 50% of our position when we get to a 1 to 3. We will at 1 to 3, at 1 to 3, we will make trade risk free. We will let rest of trade ride to structural highs, or when trade ride, in fact, to structural highs. To when structure breaks against us, which you all know what that is, when you get indication, correction, continuation against you, or to a 1 to 10 trade. If taken on smaller 1 minute time frame. Because you're not going to get 1 to 10 trade if you took it looking at a 15-minute indication, correction, continuation, or a bigger. You're not going to get to 1 to 10. The markets don't move that much, especially to trade the markets that we look at, GU, US 30. So they're not going to move that much for you to be able to say, I took it on an hour indication, correction, continuation, and let it run for 1 to 10, unless you're letting it run for months and months. All right. We will take partials. Because what this means is if we take partials at 50% and we traded 1% of our position, we make 1.5% straight away at 1 to 3. And then we let the rest ride. And if it gets to a 1 to 10, which is another 7 reward, all right, 7, because we're obviously 10 minus 3, 7. 7 times 0.5%, which is what we've got left in the trade, is 3.5%. 3.5% plus the 1.5% you took equals 5% trade. All right, cool. So we've got this here. Let me slap it all in the same font size and font, because we're all in different font sizes. We will place our stop loss. We will target liquidity or structural higher time frames. We will target liquidity, structural higher time frame highs or lows. And all structural higher time frames. Or here we go.
So did you talk about managing your risk and only taking 1% until you have a cushion of 1,000, 1,100?
Yeah, I mean, I'm going to put. I think I'm going to put in a separate document about how to pass the challenges. I think we put in a
Okay.
separate. I want this one. I was thinking there was one or two things that I've missed out on here, but I'm going to combine this with understanding because this is in combination with what we've been learning over all this time about buying and selling in a premium or a discount, understanding indication, correction, continuous. They're all the same. This is just adding an additional source on top of a deeper understanding. You're still not going to be out here taking sells when you're discounted. Because that doesn't make sense. You're going to be buying things when they're cheap. You're going to be selling when they're expensive. But when they're expensive and you've seen liquidity and you've seen it grab liquidity first and then come back down and make a manipulation M and then come back down, break the structure, and then tap back into that imbalance, you're going to hit the RAS button. Do you hear me? You're going to hit the button. Yeah. You're going to hit it.
No doubt.
Yeah, because you understand that these stars are aligning. Yeah, let's go back to our. I'm gonna keep this here, and let's go back to our charts real quick. So. When we're talking about on a higher time frame, like I said to you, these markets do the same stuff on higher time frames. Do you know what I mean? It's not even different stuff. They do the same stuff. Do you know? Now you can take counter trend trades if you're able to get in very small into the trend, I didn't put in there about trading with the trend, etc. So it needs some other stuff. But if you was to get a 1 minute entry or even a 5 minute entry within a session, that doesn't mean that you think the markets are going to go bullish for the whole session or for the whole day. It means that was the opportunity that you was able to take because you saw liquidity be taken. Because more than anything, it's liquidity what's driving these markets. It's not anything else. It's liquidity. Have a look here. Look, I'm looking at this on a 4-hour time frame. Look at this. I'm going to keep pointing them out to you, right? Liquidity. Break of structure, manipulation, W. Markets tapping back in to the imbalance. Can you see it? Your entry would have been either taken into consideration just the imbalance, which I guarantee you, if I drop from a 4-hour to a 1 hour, is a small little zone like this. Or worst case scenario, you're going to go below the bullish engulfing candlestick pattern that I know probably exists in there, or below the swing low. Either way, okay? And vice versa. Like I said, if you were taking a trade which is counter trend, when markets capture liquidity, there's liquidity here, they run in the opposite direction. And on a smaller time frame, the exact same thing happened here. But the overall mark, and what you want to do is when you're in a session, for example, you're in a New York session, London session, you want to trade away from where you've seen liquidity being taken. Within a session, New York, London, Asian, whatever it may be. Within that session, or New York or London, you want to trade away from where you've seen liquidity being taken, because that's what the session's on. Let me make my weird analogies. That's what that rave is on. They're playing jungle music. They've decided that for that next 2-hour session, the DJ is a jungle DJ or as a soca DJ. We're playing soca for the next 2 hours. You trying to go in there with your slow dance or your hip hop dance, it's not hip hop for the next 2 hours, bro. It's soca. So you want to trade away from where you've seen liquidity being taken. The next session, something else might happen. New DJ comes up, he's playing R&B. All right, cool, it's R&B now. We're going to start retracing and going back in the direction we got into. Cool. But for this session, you're trading away from where you've seen the liquidity has been taken. Yeah? Have a look at every single, like we can see these things happening time and time again. There's liquidity below these levels. We see, like, you can see it happening so many times. And once you start to see it, now look, here's another thing. Can the markets go without tapping all the way back into your imbalance? Of course they can. Can the markets go making a normal W, not a manipulation W? Of course it can. But the whole point is a man that don't believe in something believes in absolutely everything. So I'm trying to give some rules and some parameters. If I just say every single W that hits, you trade the W, then you're going to just be all over the place. There's W's everywhere. I'm looking at right now on the screen, I can see about 20 of them. But if I turn around and say this to you, watch this, I'm going to drop to my 1 hour time frame. And I say to you, first and foremost, I only want you trading in this yellow box or these blue boxes. I've put in some restrictions, right? If I turn around and say to you, when you come to the markets, let me delete, should I delete? Yeah, let me delete everything off. And you come to the markets and you see this red Asian session, this gives you a frame of what this market may be doing. Hence the reason you heard me say that I'm a bit concerned about this, that even though we're coming down and grabbing this liquidity, this market might want to push up into an area of some imbalance because we've grabbed some liquidity below Asian sessions and maybe it wants to run back past here and start pushing up here for the day. Maybe, we shall see. I don't have a crystal ball. But I am a bit concerned on a higher time frame about the fact that this market left so much imbalance and inefficiency from all this red for ages. Okay, I'm thinking to myself, does this market want to tap back into these levels before deciding to come back down? Because what you normally see, let me show you what you see a lot of the time when you start, and this will be another level that we'll go to, is when you get this, and then the market sometimes come here, what you'll see is this. The market on a smaller time frame, you might not see on a bigger time frame, will get to this previous battlefield and it will do this a bit. And then it will do that and then go. And over here, you might have imbalance starting from all the way over here, going all the way to up in here. You see, because what it's doing here is the break and retest traders, it gets rid of them here. Because break and retest traders hit the button here, place their stop just above this level, or maybe above this level. Above this level. Maybe break and retest traders place their stop here. But as soon as the market comes back in, they just hit the button here. Well, this little push stops them all out. We're looking at it and we're watching where the market, because on a smaller time frame, this is me looking on a bigger time frame. On a smaller time frame, we might see imbalance up here, etc., etc. And like I said to you, we can wait. If this is a bigger time frame trade, we'd wait for an indication, correction, continuation here before we get in, or a candlestick pattern, or what was that thing I said? Or if it's on a smaller time frame, like I said to you, and we'll get in here on the imbalance with our stop above the swing high. This happens often. So right now, you see this energy here of this market kind of shuffling sideways. It's kind of shuffling sideways against this previous battleground. Why is it a previous battleground? Look, markets couldn't break it here. Markets couldn't break it here. Then markets broke through it and then it sat on it here, sat on it here. You've heard people turn around and say, previous resistance becoming, support. Resistance becoming support, support becoming resistance. The markets broke that structure, then came back up to the level here, dancing. But it's dancing here, but I can clearly see all of these concerns, in these levels up here on a smaller time frame. And I'm thinking to myself, it's very possible that this market could also have a look at some other stuff that we've done before. From this impulse down to this impulse, where's the 50% level? All the way up here. It's not impossible that this market doesn't decide to push back in here. There's imbalance in here. I just identified a little imbalance on a 4 hour. So I'm thinking to myself, this market could definitely do this, even if it wants to go down. But on a smaller time frame, we just took a trade on a 1 minute time frame, quarter 1 to 10, of this market just simply grabbing the liquidity and then make it and then following some of our rules of the session. You see that bigger time. So right now we've captured the liquidity below here, pushed all the way down into here. On a bigger time frame, when we're looking at this 15 minute, this market might be to come out here to break this structure, to tap back in, to push up in here. Definitely might be trying to do that. It's not impossible. We're getting these breaker structures W's, and here's a lovely, on a bigger time frame now. There was one manipulation W here. We've got another manipulation W over here, breaking this structure. After I'm talking about on a higher time frame. Yeah, when we're looking at it like this, let me go to my 10 minute for argument's sake. because I'm very interested in that previous battleground. Here was structure in the London session. Remember, if I didn't have this London blocking, this just looks like indication, correction, and continuation. This just looks like a level. Yeah. So I'm saying to you, look, I'm very interested in this imbalance here, the offending area that broke this previous structure. When I go down lower time frame, I start seeing other concerns which I must take into consideration. Hence the reason why the safest entry is going to be below the swing low. An aggressive entry is going to be this you turn around. Some people turn and they only take the last imbalance, as in the closest or the lowest possible one. That means if the market turns around and does this and then goes, they just say, screw it, I missed that trade. Because they only want to take this imbalance, the last one. They place a limit order on the last one. On a 5 minute time frame, let me see if we can go to a 1 minute and even see. Yeah, you know, it's still in here. Yeah. Because they're like, listen, I want to get the best possible entry. And if I miss it, I miss it. And that's cool. I get it. Yeah. But in this instance here, looking at it on this big time frame here. Oops. Look at it. Look at it when I put the line chart. You can see these big coming up and breaking structure. This is a swing structure over here. This market is now pushing past. Again, let me relate this back to other strategies that you know and understand. We used to use Fibonacci in a golden zone from this here leg up until here. I'm telling you that where this 60, this hasn't stopped yet, so I don't know. But when it does stop, where this 618 and this golden zone is, it's a very, very high probability that that is exactly where our imbalance is sitting. Yeah, it's a very high probability that when we drop our time frames down in here, it's exactly where, I don't know yet because this hasn't finished. This leg hasn't finished. This leg could finish all the way up here for all we know. All right, this leg hasn't finished, or it might decide it wants to turn around now. In here, in this kind of area, as a point of interest. So for argument's sake, I'm looking at it and I'm like, okay, the 618 and the golden zone is here, and I can see this little, 1 minute or 2 minute in this instance, imbalance in here, between here and here. It's an extra point of interest. Doesn't mean I just hit the button, but it's another point of interest. It's another area, and this is why it makes sense me labeling these imbalances. Oops, that it makes sense me labeling these imbalances. So I know, okay, this is a 2 minute imbalance. On a 1 minute time frame, we can see, in here, just covering here to here, there's a 1 minute imbalance, and obviously covering from here to here, there's a 1 minute imbalance as well. Either way, and we can see on the larger time frame, this previous battleground here, we can see 5 minute imbalance here. Like, I don't know which one the market wants to tap into, but I know that these are points of interest for me. That my ears are going to be pricked up, my eyes are going to be sharp when that market comes back into that space. I'm going to be like, okay, what's going on? If I see bare bullish engulfing candlesticks forming on a smaller time frame, if I see dojis forming here, if I see this market pushing here and start kicking out, I get in. Even if I get in and I take an L, which I probably won't, but even if I do and the market pushes down here, well, then I add another point of interest. I'm watching it. I get in again. Yeah, this is on a larger time frame. On a smaller time frame, we showed the entry, how we was able to get into the trade as this initial liquidity was swept here, made a manipulation W, tapped in here, pushed all the way back up to the London highs. Trade done in 10, 15 minutes, if that. Market came to the London highs. It was not ready to break London highs and over here, this high, push back down, back into these levels. But now we're seeing breaks of structure once again. If this market comes and taps down here, especially if that tap down happens in that New York session. Right at the start, for all we know, this market kicks out here, makes a bigger break of structure W, it's coming to tap in here, but it's the only difference is it's 230 now and it's tapping into that area and we're getting a lovely entry in that blue. Maybe at that point in time we take a buy. You could take a buy and place your stop all the way below these lows if you wanted to. Or you could drop your time frame all the way down for a much more aggressive entry. But bottom line is that this is a blueprint. If you're not here near or in your high probability kill zones is 7:25 in the evening, 8 o'clock or something else, just leave it alone. There'll be tomorrow. If you can't see any liquidity being taken, or you can see a blatant area of liquidity, massive liquidity sitting down there below some lows that the market hasn't quite taken yet, but it's looking like, oh, I want to hit the button. Wait. Wait till that liquidity's been taken, because liquidity is the fuel. Are you going to drive to Birmingham without going and checking you got petrol first? That you ain't got the fuel. You have to get the fuel. When you see the fuel taken, now it's potential action time. Okay, I can see a nice bit of structure coming in there on a smaller time frame. Oh, that looks like a manipulation W, because it's made a nice little bit of structure and then pushed down some more. Is the next move going to break? Is the next leg going to break the middle section? Oh, the next leg breaks the middle section. Oh, great. Is there any imbalances that I can see, especially near where that middle section was that it had to break? Oh yeah, there's imbalances there. There's displacement. Okay, cool. I'm going to wait for them. And furthermore, I'm going to work. I'm going to place a limit order there and there with my stop at the highs, the higher time frame highs, and I'm going to go to work. You're going to come back from work, or halfway through the middle of the day, you're going to see that you're in profits. Because you've got all these high probability things. This isn't me that's made this up. This is many different strategies and many people over the years that have seen that in this kill zone area is the best time to take trades. They have seen when a manipulation W is made is the most highest probability time to take trades. They have seen when there's an imbalance, the market likes to come back to the imbalance. So you're combining all of these years and years and years of structure and data and trying to put them into your own strategy to make you have higher probability trades. That's it. I hope you guys have enjoyed the session. I hope you've learned something. We have run on a little pace. And let's have a look at, and obviously, you also, what I missed from that list is there high impact news coming out in regards to getting out of trades? Yeah, if there's high impact news coming out and everything's going well and you're at a 1 to 8, but you're waiting for a 1 to 10, just take your money before the impact news lick. Or, that's down to you, in fact. Maybe the impact news might send you to a 1 to 30, who knows? Yeah, but the point is you don't, go on, Jay.
No, I was going to say, could you put up that Word document so I could screenshot it as well, please?
What I'm going to do is I'm actually going to save it as a PDF and I'm going to pop it into, so I want to send it to you direct. You get what I'm saying? In fact, I'll just put it in the group. No problem. Put it in the group. All right. So have a look today. We've got some existing home sales, but remind me, guys, if you don't see it in there in the next hour or so, please remind me. All right. Existing home sales. I would write it down on my little board, but yeah. Existing home sales are happening today at 3 o'clock. I don't know if Al wants to say anything about the markets at the moment. We've got Biden's gone. He's gone to the geriatric home.
Yeah, grand rising or grand rising. Listen, home sales. Yeah, that lets you know how many sales of new houses, new properties, which is another indicator of how well an economy is doing. So again, very, very important. So yeah, the market will move on that. Every data point, as I've been saying for the last few years, are really important to the Fed. There's the Fed is Fed day is next Wednesday, 31st. Yeah. So anything leading up to that, every single data point is gonna be, as I reiterate, very important. Regards to Biden, it had to happen, really and truthfully. I think the people behind him, I mentioned this before, Jay. The people behind him are the ones that were running the country. However, with Kamala Harris, I believe Trump's a bit fearful. He doesn't really like women, does he? And she's a prosecutor. So it's going to be interesting to see how that plays out. From what I hear, they're level. Yeah, they are level. Yeah. So I believe there's a lot of people sitting on the sideline who didn't like either man, right? There's a lot of Americans don't like either man. Think they're both too old. Now one has gone, and there's a lot of people who don't like Trump. Therefore, I believe Kamala Harris will be the next president of the United States come November.
Jeez. You say, put it out there, must have put a little £10 on it, yeah? Is that what you're saying? Yeah? This is no financial advice. Yeah?
The reason I'm saying that, the markets didn't do anything So the markets are okay. We're cool with that. Yeah. See, the markets didn't go mad yesterday, did it? Or Sunday night.
I
They
tell
were
you
just
what, I tell you what I did hear as well. I heard that, straight away in one day she pulled in 84 million.
oh yeah, 150 Jay.
Oh, it's 150. Okay, went up to 150. Well, when I was seeing,
150.
yeah,
Yeah,
it basically said that all the people that were like, I'm not writing this check for a man that can't finish his words, slurring his words,
Yeah.
and can't walk up any steps. As
Yeah.
soon as they decide, as soon as they say, okay, we've got someone who can actually string a sentence that's going to embarrass us.
Yeah.
They said, okay, here's the check.
yeah,
That's what
yeah.
that's what I seen happen.
Yeah, George
Yeah.
Soros is behind her. He basically said, yeah, he supports her, he endorses her. As you know, George Soros is the one who gets the right wing had to go crazy about this guy. Remember, I don't know if you know about George Soros. George Soros is the one that betted against the pound many years ago, and he won. Yeah, and we're going back many years. This we're going back when Nigel Lawson, or one of them were chancellors, yeah, of the Exchequer. So he was the man, yeah, George Soros. Anyway, listen, as I said, they wanted someone they wanted a younger person. They've got a younger person, and I believe that they're gonna, the ones who, if she gets it right in regards to, she gets the balance right, she will be president of the United States come November.
There you go. You've heard it. You've heard it
Yeah.
here first.
You,
You get me?
you know why? People don't want to vote for Trump. There's people who do want to vote for Trump, but people are looking into this Project 2025 and so on and so forth, and they're thinking, nah, mate.
Well, he tried to come out and say he doesn't know nothing about Project
He's
2025. It's got nothing to do with me.
They tried to start it when in his last year of presidency. Yeah. So you know what? It's just people just need to do their research, but it's going to be interesting. But yeah, listen, the market is going to be priced in. We always discuss that. It's going to be a bit wicky, a bit volatile leading up to the election. Normally is anyway. But bear in mind, if the Fed cut interest rates in September, Trump is going to come out and say you're helping the other side. I'll put my money on that.
There you
You
go.
heard it here first.
There you go. Well, look, I'm looking as Alan was speaking. You can see I'm looking at EJ. All right, and I'm just obviously when I trade exactly how I teach you guys how to trade, but there's certain things I look for straight away. All right, so say I'm looking at EJ. I've gone on a higher time frame. I've seen the market's trading within a range. It's a bullish market. I think we can all agree on that. All right, we can all see that here. All right, the market. If I go to my 1 hour time frame, depending on what I'm saying, this market has been making lower lows, lower highs, lower lows, lower highs, lower lows. There's nothing to say that there's anything's going to stop it doing the same thing. Yes, I've drawn some yellow lines in, but the market's been making lower lows, lower highs, lower lows, lower highs, lower lows. Next, what is it? What could it next do? Let me say it one more time. Lower lows, lower highs, lower lows, lower highs, lower lows. What could next be on the cards?
Not a lower low,
No lower low,
a lower high. Sorry.
a lower high is possibly on the cards. Now, the reason why I'm giving it extra kudos about that lower high is that ultimately we're in a discount down on this yellow line. Now, look, there might be some other things have changed. Japanese yen's changed. It wants to completely change the energy, blah, 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 blah. But, possibly a lower high could come. Now, that doesn't mean that I know that this is the lowest low. This lowest low could continue pushing down here. Ultimately, I'd prefer to be taking that trade with this market on this white line here, down here. So this market could keep running down here. It could do. Because this would be me taking it from a discount in here. And it's, even though it's broken outside of this yellow range, the structure is here. You see, the market's allowed to come all the way down here without breaking it, and it would still be bullish structure overall. However, on a smaller time frame, I'm looking to see where the liquidity is of where this market could be reaching for. So we've seen here, if I can zoom in a bit, that in London, Asian session was here, London started and the market pushed down here, not only grabbed liquidity from this Asian low over here, also grabbed it from a previous London session over here, some liquidity below here, and it's still pushing down pretty aggressively to this other area of a red line of some liquidity, which is down here on this area here. Maybe the market wants to come and eat that liquidity before deciding it wants to tap back into the area like over here. Now don't get it twisted. You catch a trade from there to there, from here to up into these levels. It's a good 85, this is a 100 pip trade. Even though the market may still want to keep coming down. Do you understand? But if this session, if right now this starts moving in here and maybe in here, within this yellow box that we're still in, which is a kill zone window, that I see a great opportunity. I see what we're looking for all over on our list after liquidity. Because look, liquidity has already been taken from here. I just haven't seen what I need to see on our list to get excited. There's been no breaker structure. There's been no push out, no leg out. There's been no manipulation W. This looked like it might wanted to do it. Look, came down, came up, came down. Is this a manipulation W? No, it's not. Not at the moment anyway. Yeah? We are in a kill zone area, yes. But I haven't seen what I want to see. So maybe this market might continue running down to capture this little red line liquidity. And then if we're now out of the window of trading, I can just leave it alone. If we start getting close to the new window of trading 230 around here, have a look. Let me draw a vertical line. Around here, so I'm talking about from 2 o'clock, from around those areas, and we're in here doing something after capturing this liquidity, and I start seeing breaker structure. But I'm in for the buy. I'm in a ramping. I'm in. Of this market being able to turn around and start doing this, but only if I see what I'm seeing, and I'm giving myself these rules and these walls and these time frames to restrict my trading. Yeah, guys, amazing day. We're going to do some more of this tomorrow. I will make a PDF of that document. Let me just clean it up a bit, make sure it makes sense. Add some little bits and pieces to it. But what I am going to do right now is I'm going to go into our, our live room. We're going to put something educational on, and we could put something. Tell you what we're going to do. We could put something about trading. We could play Dr. Umar, who's got something that just came out 24 hours ago. Or we can put something about the UK property crisis. So UK property crisis, Dr. Umar, or something about trading in regards to 300K payout, 7-figure funded trader, something like that. First the post wins, whatever you want to do, we can do.
Let's do the funded trader.
Let's see what the funded trader said, no problem.
Yeah,
7-figure funded trader, 10x, 4x with Ryan Chowdhury. I think I've seen him speak on other things. These guys, it's like a small community. They speak on one thing, they go to another podcast, another. Let's see what someone's saying in the chat. No problem.